visible, right? Right. Okay, so we will start today's lesson. So how are you? Keeping fine? Yes, online students? Keeping fine? Huh? How was the week? Yes, fine, no? Right. Okay, fine. So let's start our discussion now. We have started already discussing about financial markets last week. So if I give you a brief summary regarding the things that we have discussed. Now, when it's come to the financial markets, before we are learning about financial markets, we learn about what financial system is. You know that when it's come to the economy, there are many parties, individuals, we call them as households, business firms, government, and international sector. So what they do is they are making their decisions. For them to implement their decisions in a smooth and a proper way, there must be a proper platform available. It may consist with financial instruments, financial infrastructure, central bank, banks and other regulatory bodies, financial instruments, right? Financial markets. So this entire collection together, we call it as financial system. So in this financial system, there's a one particular component that is what? Financial markets. So that was our topic, financial markets. So we learn about what financial markets are in a very simple way. It provides some sort of a platform to share the funds among investors, among surplus units with deficit units. So when it comes to these financial markets, there are many functions and we discuss the categories of financial markets. Now, basically, we can divide the financial markets into two aspects, money market and the other one is capital market. So if you are trying to go for a short-term investment, it is for money market. So you have a different motivation patterns. You need a quick return. You invest your money until you get an emergency, right? For a short period of time. So under that, we learned interbank whole money market, uh, interbank whole money market, treasury bill market, forensic market, as well as the other one. What is that? Interbank call money market, treasury bill market, commercial paper market, interbank foreign exchange market. So then we started our discussion with regard to the capital market. So capital market is for a long-term investment. So the people who are investing in those markets have a different behavior or a motivation rather than the people who invest in money markets because capital market is long-term returns. Right? So you have to wait and see. Right. So after that, we discuss about market, right? Many components with regard to the stock market. And I have given you a homework as well. And I observed that some of you have uploaded that particular task in LMS. Right. Okay, good. So now today we'll start with the other type of capital markets, that is corporate debt security market as well as treasury bond market. Now, you know that when it's come to a company, they can issue, simply they can generate capital by issuing equity shares coming under the equity capital as well as debt coming under the debt capital. Right. So the company can issue shares and also company can issue something called debentures. Right. The company can issue debentures. So this particular debenture market considers that particular angle or that particular aspect. So we are going to discuss about debentures in our next lesson as well. Now this is something like company issue shares to the shareholders, then they subscribe their funds to the company, and they are getting a return. We have not guaranteed, but we know that yes, they are entitled for the dividend payments, right? They are entitled for the dividend payments. But when it comes to the debentures, But when it comes to the debentures, what happens is company can again issue debentures to the debenture holders, right? Here, if you look at this, now this is the company. Company can issue debentures to a certain type of people. Once they purchase those debentures, we call them as debenture holders, right? Debenture holders. So what they do, they provide money to the company, right? They provide money to the company. The most important thing in here is that when the company issue shares, such shares do not have a maturity period, right? Do not have a maturity period. For an example, let's say if you are an investor of a JKH, John Keel's Holdings, do you have a maturity period for shares? No, you don't have a maturity period. But when it comes to the debentures, it does. Right? So let's say 3-year maturity, 5-year maturity, something like that. What happens is during this maturity period, the company has to pay interest, right, to debenture holders. The company has to pay interest to debenture holder. Could be annually or could be semi-annually, right? Then once the maturity period occurs, let's say year 1, they are paying the interest. Year 2, they are paying the interest. Year 3 also, they are paying the interest plus the redemption value of the debenture. The invested amount, the company will pay them back. So this is how it operates. Right? This is how it operates. Clear? So this is also has two markets, primary market and secondary market. So usually you could see that company issue debentures, right, to the debenture holders. That is the first time aspect and we call as primary market. So once they sell and buy the debentures with the other investors, we call it as secondary market. But one of the interesting point here is that even though we have a active secondary market for the shares, we do not have that much of active secondary market for debentures. What could be the reason? So for an example, let's say you purchase shares through an IPO, initial public offering, right? Initial public offering, right? So let's assume that you are entitled to get what? By purchasing shares, you are entitled to get what? Dividends, right? Dividends and capital gains. But the company does not guarantee that you are getting the dividends. So what you would do anyway, you have done an investment to get a return. Based on the price fluctuations in the stock market, you can sell some of your shares and convert them into capital gain. Because nobody has guaranteed that you are getting a return. It's up to you. But when it's come to the debentures, once the company issue debentures to the debenture holders, they know that they are getting a fixed interest until the mature occurs. And also, at the end of the maturity period, they know that they can get the capital gain. So their return is guaranteed. Accordingly, they are not going to sell their debentures in the secondary market most of the time. Right? Because someone is guaranteed that they are getting a return, isn't it? So no point of selling the debentures, but still some of the people are they selling, but we don't have that much of a active secondary market for debentures. Okay, so that's what here you could see when it comes to the debentures. Here it says in Sri Lanka corporate bonds. So debentures are mostly the medium term debentures issued by banks, financial institution, and few corporates. Right? Most of the time, these debentures are by finance and banks in Sri Lanka. Right? Right. Okay. So most of the time in Sri Lanka, you can see that these type of debt securities are issued by banks, right? And some of the manufacturing companies can issue, but most of the time it financed companies. So these debentures generally have a maturity period of 5 years. So usually, the debenture market in Sri Lanka is active in the primary market. However, there is hardly any secondary market as investors mostly prefer to hold debentures until maturity. Since as a debenture holder, so that you are going to hold the debentures till maturity, accordingly, you are not that much willing to go and sell your debentures in the secondary market. So if you go to the stock market website, you could see if you click the equity summary, massive tradings are there. But if you click the date summary, something like that, right? Okay, so this is simply the debenture market in Sri Lanka. Debenture market in Sri Lanka. And the other market is treasury bond market. Now you got to know that what are treasury bills and how it operates. Same operating mechanism happens in India also. The only thing is you need to know what are treasury bonds. Okay? So if the government needs short-term financial requirements, they issue what? On behalf of the government, central bank issue treasury bill. So the treasury bonds are what? Long-term. If the government needs long-term funding requirements, on behalf of the government, the public debt department of the central bank issue treasury bonds. That is for a longer term period, 2, 10, 30, something like that. That is the right? So risk-free securities, we call them as risk-free securities. Why? You don't have any risk, right? The government will pay you. There is a bankruptcy or whatever, the government will pay you. So treasury bond market. So here it says treasury bonds are issued by central bank to fund the budgeted expenses of the government. Right. So as agent of the government of Sri Lanka, the public debt department of Central Bank of Sri Lanka issue treasury bonds, pays interest on due dates and repays the principal on maturity. So you need these characteristics very much. Why? Because in your next lesson, we are going to the valuation. So for the valuation, you need these things. Okay. Right. Very simple two markets. Corporate debt security market as well as the other one is treasury bond market. Okay. So please read these two slides. Check whether you're okay. Right. Okay. Online students, are you all okay with these two markets, Buddha?
Yes, sir.
Right. So now we are going to discuss about a different type of a market. It's not coming under the capital market. So I will explain how it happens. Right? So simply we call this as the unit trust market. Right? Unit trust market. Do you know about unit trust? Yes. Do you know about unit trust? Some sort of an idea is there. No? Fine. Good. Yes. Online students, any idea about unit trust market? Yes. Any idea? Right. So now what happens is in this type of a market, I will show you what happens. Now we have the investors, right? We have investors. Now, if you look at these investors, now actually some people do not possess the relevant investment knowledge, but they have funds, right? They have funds, but they don't know how to do an investment. Some people are there, they have funds, they know how to do the investment, but they don't have time, right? Because investment is, I'm not considering about the short-term investment. If it is a long-term investment, you are putting your hard-earned money into different investment opportunities. So before doing that, you need to consider more things, right? More things. If it is a company, you have to do a lot of analysis, starting from fundamental analysis, technical analysis, economic analysis, many things you have to do. So which means, let's assume that you don't have time, right? So then what happens is you don't have time, but you have funds. You don't know anything about investments, but you have funds, right? So there are particular companies available on behalf of you to do your investment, right? On behalf of you to do your investment. So we call it as unit trust companies, right? Unit trust companies. Now what happens is, so they have a particular fund called unit trust fund, right? Unit trust fund. These are some of the parties in the unit trust market. And here we have the Securities and Exchange Commission, right? Securities and Exchange Commission is there. And here we have unit trust fund manager, right? Unit trust fund manager is there. And here we have trustee for the custody, right? Okay. So now one of the company is getting funds from you and they do investment on behalf of you, right? You are putting all of your funds into a particular company. Then on behalf of you, they do your investment, right? So accordingly, it must be monitored. Am I correct? Right? Your fund is being handled by one party and that must be monitored, right? So that monitoring part will be done by Securities and Exchange Commission. Securities and Exchange Commission monitor the unit trust fund as well as they monitor the performance or the regulatory background of the unit trust fund manager, right? Unit trust fund manager. And here you have the trustee or the custodian, usually a bank. They also regulate the performance of the unit trust fund as well as the unit trust fund manager. That's how the regulatory mechanism happens because you are using someone's money to do your investment. Right now, when it comes to the company, what happens? You are the one who invests in the company, right? You are the one who invests in your company. But here, on behalf of you, a particular company do the investments, right? On behalf of you, a particular company is doing the investment. Now say what happens here. Let's assume that you are doing your investment, right? Let's say you invested 5 million into this unit trust funds. Accordingly, you are getting something called units. If you purchase shares, you are getting shares. If you invested in unit trust funds, you are getting units, right? The value of the units depends on the market values. According to the amount that you invest, the units will be allocated based on the prices of the units at that time, right? So then what happens? This unit trust fund consists with 5 million, right? 5 million worth of cash. So what they do now, unit trust fund manager is the person who manage this. They will do the investment, right? They will do the investment on behalf of you. Investment. They can invest in money markets and capital market. Your money is being invested by investment manager in different markets. Could be treasury bills, could be treasury bonds, something like that. Okay, treasury bills, treasury bonds, commercial papers, shares, debentures, and many markets. Right? Then the return will be shared considering the number of units held by this particular investor, or considering the value of the money that the investor has invested. Right? Is this clear? This is the operating mechanism. Huh? These are our assumptions, are simple assumptions for us to understand. You don't know anything about investments, but you have money. You know everything about investment. You have money, but you don't have time. So there's a particular companies in the market, we call them as unit trust companies or unit trust fund managers. In their company, they have a investment pool. We call it as a unit trust fund. What you could do is you can put your money into this unit trust fund. Accordingly, you will be given the number of units considering the amount that you have invested, like shares. Okay. Right. Then what happens? These people now they have investment managers, portfolio managers, investment advisors, many people. What they do, they invest your money in different investment opportunities. Could be in money market securities, could be in capital market securities, depending on your objectives. Right? Depending on your objectives. Many funds are there, and these companies also having many funds, equity funds, fixed income funds, right? Many funds are there. Many funds are there. You can select whatever the funds you would like to wish. Then you can put your money. They will invest in those money. Then the return will be shared considering the number of units or number or the money that you have invested. Since your money is being utilized by one party for do the investment, that party as well as that fund will be governed by Securities and Exchange Commission as well as a particular bank or a trustee or a custodian. Okay, so you can put your money whatever the time you want, and you can redeem your money whatever the time you want. So it's entirely online transactions. It's just the putting the value that you want to redeem and execute. Now, what happens is most of the people in Sri Lanka do not have an idea about these unit trust market. But if you look at, if you have these satellite TVs, and if you look at these, you are watching matches, right? Ten sport and everything, right? So you can see that they are using many celebrities to promote their unit trust market, right? You might have seen. But in Sri Lanka, there are some companies, right? Capital Alliance, Sea Bank, many companies are there, but the awareness among the public regarding the unit trust is very much low. Very much low. So this is what simply a unit trust market is, right? Unit trust market is. Right. So here, if you look at the lecture material, it says a unit trust is a pool of funds collected from a number of investors who share common financial goal. You could say unit trust is a fund collected from number of or many investors who share a common financial goal. What could be their financial goal? To obtain a return, right? To obtain a return. So the fund collected from the investors are invested in various financial assets, money market securities, as well as capital market securities. Here you could say I mentioned treasury bills, treasury bonds, debentures, and other securities. The income earned from these investment and the capital appreciation is shared by its units holders in proportion to the number of units owned by them. So they are collectively do the investment accordingly. Profit will be shared based on a particular basis, right? Particular basis. So these are some of the funds available by the unit trust companies, right? So they have gilt-edged funds, which means you are getting a higher return. The risk is also high. Income funds, or high yield funds, growth funds, index funds, which are linked with particular indexes. Then the money market fund. Different funds are there. You can just click execute. You are not doing the investment. You are putting the money and you just click what are the investment that you want to do. Okay. So these are some of the unit trust management companies in Sri Lanka. Apico Traxia Asset Management, Asset Trust Management, Asset Line, Kendo, Capital Alliances. Now they are doing a very good job, Capital Alliance. T Bank Asset Management, Ceylon Asset Management, NDB Wealth Management, First Capital and Guardian Equity Asset Management. So these are all the companies available. Right, so it's just filling the form and having the online know your customer discussion and execute the filling of the application. Marketing breakdown. Is this clear? Is online students is it clear to the?
Yes, hi, sir. Good morning.
Yeah, good to that.
Sir, I have one small concern regarding unit trust market.
Yeah.
So you highlighted that money factor and the time factor of investors. Can we consider the risk factor also? Maybe the investors like to invest in unit trust to mitigate their
Very
risk.
good. Very good question. Right now, this is one of the prominent factor you need to consider. Actually, before you selecting your now unit trust company is the one who do the investments, right? Before selecting the unit trust company, you need to analyze their risk profile also, right? You need to analyze their risk profile also. So you can go to their websites and simply they have mentioned up to certain time period what type of a return that they have provided to their investors. You can analyze. Now this is what actually this is Janaka, right? Janaka.
Yes, sir.
Like I go, your friends just don't know Karna saying, right? I know. Right. Right. So simply you need to analyze the unit trust company itself, right? Whether they are credit ratings, whether it is double A minus or double B minus. First you need to analyze unit trust company, right? In terms of their credit ratings and the returns that they have provided to their investors during a particular period of time after deducting certain fees, because your fund will be managed by a particular company and they need to, it is a right of them to deduct some fees, right? So after the deduction of those fees, the return series are available. You can check what type of a return that they have provided, what type of return that they have provided. So that is how you analyze the risk profile of the unit trust company. Now, when it comes to the investments, they are the one who analyze the risk and return based on your objective. Is that clear, Buddha? Right now, if we know that, for an example, let's say now in their particular website, they have different funds, fixed income funds, equity funds, something like that. So as an investor, you also need to have some sort of an understanding about which type of a fund is that. If you if you pick a money market investment, risk is lower. Why? You are getting a quick return, right? You are getting a quick return. So likewise, you can pick the particular fund in terms of its risk, right? In terms of its risk, if you go for a high yield fund, definitely risk is high, but you are getting a high return. Is that clear, Janagan?
Yes, sir. Thank you.
Okay, fine. Right, very good question. Now, simply you need to analyze the risk of company as well as you need to think about the risk profile of these fund categories. They are doing the investment. If you pick a money market fund, they will decide whether to go for a treasury bill or repo market, right? So both are risk free, not repo, treasury bill market. So if you the initial stage you have to do it, right? Initial stage you have to do it. If you select high yield fund, the name itself says high yield. If you want a higher return, definitely the risk is also high. Clear? Good. Then income fund, you are getting monthly or a quarterly income. So the risk is lower. Clear? Good. What type of questions that comes with regarding the beginning class market? Right. Okay, fine. Clear? Right. So that's simply the end of the discussion of the capital market. Right, so we discussed about share market, debenture market, and treasury bond market. And this is a different kind of a market, that is unit trust market. Right, so finally, we have discussed about brokers, type of orders, and margin accounts. And to identify who are the brokers, you can go to the stock market website, and in there, you could see the stock firms are there. Definitely, there are nearly 50 to 80 stock broker companies available in the stock market. And for the type of orders, you might have seen that I have uploaded a particular PDA to LMS. It says ADS, right? So if they are in there, we have highlighted particular areas that you want to read. Read only that part, huh? That part. If you want to read more, you can read. But for this study purpose, only the highlighted areas. Right? And the other one is margin accounts, right? So you can see this is what I have uploaded to LMS, automated trading rules. Right? You can check it's there in the LMS, right? Then the other one is margin accounts. Right now, if I ask you a smaller question, how you can buy the share in a company? Just filling the application or putting an online account like that. You can buy the company can buy the share of a particular company by using your own money. Am I correct? By using your own money, you can buy the company share. What could be the other aspects? If you are not using your money, then the other option is you should take about stock market. Let's think you are purchasing a car. You can purchase your car by using your own money for fees or loan. Simply the category of loan. Likewise, when it comes to shares also, we can provide some portion of the total investment value and the broker will lend the remaining portion. Broker will lend the remaining portion. It's something like a loan, right? Something like a loan, right? For an example, let's say, is that okay if I is this? Is that okay if I is this? Right. Right. So for an example, let's say, right? So you are going to do an investment, right? You are going to do an investment. The value of the investment, right? value of the investment is equals to, let's say, 200, right? Value of the initial investment is 200. But you only have, this is just an example, nah? Just an example, because there are certain percentages. This is just an example, right? So the value of the investment that you are going to do is 200, but from your end, you can only provide 100 rupees, right? You can only provide 100 rupees. So the remaining 100 rupees will be provided by your broker. Right? Remaining 100 rupee will be provided by your broker. Right? So we call it as margin trading. Now, most of the companies are there. Recently, Dialog is also they are doing the margin trading activities. Right? Margin trading. One portion of your investment will be paid by you. The remaining portion will be done by the stock brokering company. Right? Stock brokering company. So this is what we know as margin trading. There are a lot of things under margin trading, but according to your syllabus, you need to know what is margin trading, right? The one portion of your investment will be provided by the broker, sorry, yourself. The remaining portion will be provided by the broker. So you have to call and ask how many days will you be given to pay this? Is there any interest in between these periods? Usually we are saying in between 3 to 4 days we have to pay, but you need to call and confirm whether the broker is charging interest for that particular period or not, right? Depending on the value of the security that you're having, they have two types of margin, initial margin, as well as the other one is maintenance margin, initial margin, as well as the maintain margin. Maintain or the maintenance margin, right? This is simply what the margin trading is. Depending on the value in your account, they will decide what is the initial margin. Right? For example, if the value in your account is 100, initially they will provide 50%. Accordingly, the value will be 150, right? 150. So this is the value of your account. Based on this account, they will provide you the loan. So we call this as the margin. This is the margin. Right, so this is for your additional knowledge, additional knowledge. And so simply what is margin trading? Margin trading is, now before that, you can do your investment by your own money or by taking the money from your stockbroker. That part is known as margin trading, right? That part is known as margin trading. Based on the value in your CDS account, initial margin will be provided, would be 50%, right? Would be 50%. And you have another margin for maintenance margin, that is the value that you have to maintain the account. And so usually when you go on, you have to keep what? Collaterals. So accordingly, they keep the value in your CDS account as a collateral, right? Value in your CDS account as a collateral. Right, so here you could see when it comes to stocks, there are two ways that you can buy it. By paying the purchase price in full of funds available in your account, by using a margin account and borrowing to invest. Simply, the broker will get. A margin account is a brokerage account which allows you to borrow money against the investment in your account. Right? Based on the value in your account, broker will decide. Broker will decide. So broker is having several agreements with other financial institutions. Broker is having several agreements with other financial institutions. Here it says let's say you purchase a stock in a margin account as the buyer, you pay a portion of the purchase price, right? So if the value is 200, you pay 100, right? And the broker lends you the difference. The remaining 100, the broker will pay it. You have to pay the interest on the broker's loan, and it holds the security as a collateral. The value of your account will be considered as a collateral. Any income or interest earned in your account may be used to help you offset the cost of borrowing. If you get a return, you can use it to settle it. Right? You can use it to settle it. Right? So this is simply what margin trading is. Broker is having many agreements with different one or two financial institutions, and based on that agreement, they will decide those interests. That's why I ask you, when you are going for these type of a particular trading, better you call and ask from the broker how many days that they allow you to pay this back, or up to which days the interest will be calculated. So you have to call and ask, because the policy could be depend upon the agreements that they have with other financial institutions. Broker, yes. You have an agreement with financial institutions, otherwise. Right, okay. Please read this, the higher part of your financial markets. Did you right? You have calculators, no? Right, okay, fine. Are you okay with these things? Yes, online students, are you all okay, Lala? Fine. Yes, online students, are you okay?
Yes, sir.
Right, fine. So that's the end of our financial markets lesson, right? That's the end of our financial markets lesson. So what we discussed here, so what are the things we discussed? Right? We discussed about many markets. And we don't know what are those markets, isn't it? Many markets. Okay, many markets. Immediately, just look at your lecture materials. Just to recap, within 2 minutes, just to recap within 2 minutes, online students, please do the same. Right? Just think whether you have some sort of an idea regarding these things. Right? First, we discuss about what is financial system. Today morning also I provided summary, what is financial system. So we know that when it comes to the economy, there are many parties, households, business firms, government, and the foreign sector. So what they do, they make decisions. To implement that decision, you need to have a proper platform. Right? So with central bank, financial institutions, financial markets, uh, financial infrastructure, many things. So this selection together we call as financial system. Under this financial system, there's a particular component that is financial market. So that was our lesson, right? That was our lesson. So when it comes to the financial markets, we know that it's a particular place where the surplus units and the deficit units would exchange their funds. Accordingly, we have divided these financial markets into two types, that is money market and capital market. So when it comes to the money market, it is for short-term investments. Short-term investments. So under that we discuss about interbank foreign money market, interbank foreign exchange market, treasury market, and commercial paper market. Thereafter we start discussing about capital market. Capital market is for long-term investments. Capital market is for long-term investments. And there are many functions we discuss under the capital market. So we discuss about stock market, debenture market, bond market. And finally, we discuss a different type of a market called unit trust market. Different type of a market called unit trust market. Finally, we concluded our lesson by discussing margin trading. Margin trading. Okay, right? Right. Okay, fine. Yes, 60% confidence. 60% confidence, remaining code you have to study that. Right? 60% confidence is okay, fine. Right, or online students, I think you all are okay. Right. Okay, so we'll start our next lesson. Right, we'll start our next lesson, that is right. Very nice lesson. Valuation of bonds and shares. Right? Listen, huh? Right. Okay, fine. Right. Now we have completed your lesson number 1, lesson number 2, lesson number 3. I will give Thank you. Right. Yes, excellent. I think you can see the screen.
Yes, sir.
Okay, fine. Right, fine. So we have completed your lesson number 1, lesson number 2, and lesson number 3. I will inform what type of the way that I am going to do it. Right, could be a assignment kind of a one. Regarding time management, we can do and financial mathematics. Fine. Right, so now today we are going to start valuation of bonds and shares. Very easy lesson, valuation of bonds and shares. So if you understand it properly, it would be a easy lesson. And please note that when it comes to your examination, you will be getting a compulsory question which accumulates to 28 marks. Right, which accumulates to 28 marks. So it would be from valuation for your next topic, that is cost of capital. Right. So if you go to your LMS, you can see that I have given some practice questions for you as well. Right. So once we leave the cost of capital, I again upload some practice questions. Right. So in the near future, we'll see whether we can discuss it or I can upload the answers as well. Okay, so let's start the valuation of bonds and shares. Now these are the lesson outlines, right? Lesson outlines. Simply, you are going to know how to value shares, features of debentures, basically debentures, and the valuation of debentures, right? Valuation of debentures. So once you complete this lesson, you will be able to identify different types of shares and debentures, how to apply the share valuation techniques using dividend valuation and price earning method. We have Lakshmi model and other models. Simply, we will look at the dividend valuation and price multiplies. Then recognize the key features of bonds and related risk. Finally, apply the bond valuation techniques. So these are the things you are going to learn. Okay. Right. So these are the things you are going to learn. Now, if I put in a very simple way, right? So I want to show you the broad picture, right? Where what is our final destination, right? It's very simple, huh? It's very simple. Simply, you are going to learn how to value the share and the bond in the market. For an example, let's say you can see that when it comes to the London Stock Exchange, if we let's consider investments. Let's say their share price is 250. Example, their share price is 250. So that depends on what? The market price. It is the market price, isn't it? That depends on what? Demand. And supply. That depends on demand and supply. Now, what we are going to do, we are going to calculate the theoretical price of that share based on finance models. Clearly, if the 8 constraints PLC share price is 250, actually that depends on 200 market demand and supply, right? So let's say the 8 constraints companies there and their share price is, let's assume it's 250. So this is the market price per share of that company, which depends on demand and supply, right? Which depends on demand and supply. What we are going to do, we are going to calculate another price, right? I'm using that word, another price of the same company, right? Of the same company using several financial models, right? Several financial models. Then we are going to check whether this share is actually worth this much or not. Why do we need to do it? Because if you are going to do an investment, you need to check whether actually that share is actually worth this much or not, right? If the price that we have calculated is equal to 300, you can determine whether to purchase or sell the share, right? That is why we are doing this particular lesson, right? Simply, we call this as theoretical price or the intrinsic price. We can check our calculated price with the existing market price to make our buy, hold or sell decision. Buy, hold or sell decision. That is why we are learning this lesson. And the similar concept apply for the bond valuation as well. Okay, right. There are some technical aspect that you want that you need to keep in your mind. Right. Now here it says introduction to valuation, right? Introduction to valuation. Then don't read, huh? Don't read. Don't read. Just look at the board. Just look at the board. So this is the usual example that I'm making. Let's say now without moving to these big financial instruments, let's consider about our day-to-day life, right? For an example, let's say in your company, you are the finance manager, right? In your company, you are the finance manager, and company needs to purchase a lorry, right? Company needs to purchase a lorry. Right? Company needs to assume this is a lorry, even though it's like a hatchback model, right? Company needs to purchase a lorry, and seller is there. Seller is there, and he says this lorry is 7 million. He's going to sell this lorry at a price of 7 million. So now you are the finance manager, so you are not going to go and do these things. Any evaluation must be done by professional valuer. So your team goes to meet this seller, right? Your team goes to meet this seller. This is your team, huh? Right? Meet this seller and make some discussions, right? Make some discussions. We call them as negotiations. Then you come back again, right? Then you come back again to the company, right? You need a lorry, and the value of the lorry is 7 million. Tell me what you should do. If you want this lorry, you have the money, huh? Don't worry, you have enough money, and the value of the lorry is 7 million. You again come to the company and tell me what you should do. What you should do. Sorry. Yeah, you need to do a valuation. Simply, if I put in a simple words, simply you need to check this lorry is actually worth 7 million to you. Am I correct? Simply, just like a mobile phone, na, you need to consider whether this lorry is actually worth 7 million to you. For that, you need to do a proper valuation to get the, we call it as a professional judgment, right? To get the professional judgment from a professional valuer, right? For an example, let's assume that your team, I'm using that word team, your team has decided the useful life, right? The useful life of this lorry is 3 years. Useful life of this lorry is 3 years. So usually you are purchasing this lorry for what? You are purchasing this lorry for what? To go trips, huh? To distribute your products to different distributional channels, right? Let's assume that, right? Let's assume that you are using this lorry for 3 years, year 1, year 2, year 3. right? Year 1, year 2, year 3. So please consider these are very basics, very simple example and very basics. So you are using this lorry for 3 years, then you need to estimate how much of net cash inflow you are going to get this by using this lorry. Simply cost benefit analysis, right? Simply a cost benefit analysis. So let's say in the first year you believe that you can get a 2 million net cash inflow. In the second year, you believe that you can get a 3 million worth of net cash inflow. And year 3, 2 million of net cash inflow plus what? Plus what? Selling value of that asset, right? Scrap value or the selling value of that asset. Let's say, let's assume that it's 3 million, right? It's 3 million, right? So you are in year 0, right? You are in year 0. From year 0, you are predicting your future net cash inflows, right? From year 0, you are predicting your future net cash inflows. So what you need to do, since you are in year 0, you need to bring all these cash flows into today's term, right? You need to bring all these cash inflows into today's term. Accordingly, what we do, we are going to discount it, right? Let's say, what of at least 10%, let's say, right? 10%, 1 plus 10%, right? Plus. See, we are discounting. Is this present value or net present value? Present value or net present value? Present value. Good. So you are in year 0. Let's say the present value of this lorry after you discounted is equals to 5 million. Right? 5 million. Seller says it's 7 million, but if you do an analysis, this lorry actually worth 5 million to you. What you should do? Buy or hold. You can't sell because you don't have it. Hold. Hold. Right? Simply, the market price of the lorry is 7 million. The value that you have calculated is 5 million. Market price is higher than the value that you have calculated. So which means we call it as overvalue. Overvalue. Accordingly, our decision, we were planning to buy. Now we are not going to do this, right? So we are going to hold the decision. Right? We are going to hold the decision. So this is how we simply what valuation is. Actually, I have took this example because rather than considering the financial instruments at the very beginning, this lorry is somewhat familiar to me. Oh, what is a lorry and everything. Right? So simply what you need to do, yes, we need to compare these two and check whether it is over or under value, then make your decision. That is what we are going to do. Clear? Simply, right? Simply, you could say that you have determined the value of this lorry by discounting all your future cash flows, right? By discounting all your future cash flows. So we can say value of an asset is equals to present value of its expected cash flows, right? Value of an asset is equal to the present value, right? The present value of its expected, not the present, expected cash flows, right? Value of an asset is equals to the present value of an of its expected, right? Clearly get this meaning, expected cash flows, right? So based on this principle, we have different models, right? This is the base. This is the base foundation. So if you look at your lecture material here, you could see there is something called real assets and financial assets, right? Real assets and financial assets. So real assets are tangible or physical assets, right? Something like a lorry. Here we are not going to do the real asset valuation, but we are going to do some of the financial assets valuation. Those are shares and bonds or debentures. Then the second part, you could see the concept of return and risk. Now, if you look at this formula, can you see the return here? What is the return? Here, these are your returns, right? Simply cash flows, yes, these are your returns. The concept of return and risk. By looking at this formula, can you identify the risk? So simply, we are using discount rate. Discount rate is the cost of capital rate. Cost of capital depends on risk, right? Cost of capital depends on risk. Accordingly, it captures risk up to some extent, right? So usually we are measuring risk using beta and the standard deviations, but up to here, it captures the risk up to some extent, right? It captures the risk up to some extent, right? Look at the rationale. Here we are taking the cost of capital. Discount rate is your cost of capital, isn't it? Which means your next lesson, cost of capital depends on the risk. Hope you remember that under the financial decision in our first lesson, I explained this. So cost of capital depends on risk. Accordingly, this captures the risk up to some extent, right? Therefore, you could see return and risk as the determinant of the value, correct? Based on the risk and return, you determine the value, right? Based on the risk and return, you determine the value. It says are the fundamental and valid to the valuation of securities as well as to the physical assets. Simply, if you are going to value the real assets or the financial assets, this is the base, right? This is the base. Into you are considering your return and the risk, right? Net cash inflows with the discount rates together valuing the asset. Are you okay? Right. Then, okay, first you will write this. Online emails, are you okay up to now? Online emails, are you okay up to now?
Yes, sir.
Okay, fine. If you can't understand any word, you can ask, huh? Right, okay, fine. Right. Okay, shall we move from the discussion from lorry to financial assets? Shall we move from loan to financial assets? Huh? Now this is okay, right? To some extent. Okay. Okay, shall I erase this? Okay, fine. Okay, fine. Right. Right. So the final one, there is something called efficient capital market, right? You can see that there is something called efficient capital market. Now, let's move our discussion from real assets to financial assets, right? Let's say there's a company called ABC and the market price of this ABC company is 100 rupees. Market price of this ABC company is 100 rupees. It depends on the demand and supply for that particular share at that time, right? So you have calculated the intrinsic value of the share. Let's say it's 150, right? So this is the value that you have calculated of the same company, and this is your. So it depends on demand and supply, and you have calculated the intrinsic value of the company. Let's assume it's 150 using finance theories. Right. Market price is lower than the value that you have calculated. That is the first thing that you want to know, right? Market price is lower than the value that you have calculated. Accordingly, is this undervalued or overvalued? We call it as undervalued, right? If the share is undervalued, it would be better to consider to buy the share. But you need to do a lot of analysis before that when it comes to the price earning rate valuations, right? Usually we say if the price of the share is undervalued, better to buy, right? Why? The price is lower. So you can buy. Once the price increases, you can get the capital gain, right? This is the first scenario. Then let's assume that the market price of the share is 100 rupees and the intrinsic value is equals to 75. So here the market price is higher than the value that you have calculated. We call it as what? Yes, we call it as overvalued. Right? We call it as overvalued. If the share is overvalued and if you already have that share, better to sell, right? Better to sell the share. Very simple. Now you know that if you are having a car like let's say Maruti or Alto, usually the price could be in between 15 lakhs to 17 lakhs if I'm not mistaken. But due to the crisis we are having with these import restrictions, you might have noted that the second-hand market for the vehicle prices have been increased. Right, so the actual worth of the Alto or Maruti could be 15 lakhs, But in the market, it will be, it has been traded to 22 lakhs. As a owner, what you should do? You can sell your car simply like this, right? Simply like this. Okay, so it depends on whether now this overvalued and the decision, undervalued and the decision depends on whether you have the share or not. Huh? Whether you have the share or not. This is the second situation. Let's assume that the market price of the share is 100 and the value that you have calculated is also 100. Undervalued to overvalued, then undervalued to overvalued, we call it as, yes, it's equal, we call it as fairly valued, right? Fairly valued, right? Fairly valued. If the situation is like this, right? For an example, your lorry, the seller says 7 million, you did the valuation, it's also 6.99, 7 million. So if that is the case, we call it as the market is efficient, right? We call it as market is efficient. Why? You cannot make any profit in this type of a situation because the actual price is also equal to the market price. So the market is efficient, right? Market is efficient. Right now, we have done a lot of research for this Colombo stock market regarding its efficiency. What do you think? Okay, fine. Fine. Yeah. So if the situation is like this, the market is efficient, but it is very difficult to have this type of a market. So if you look at this US market, up to some period, little bit of efficiency is there, but for a longer period of time, it is not that much efficient, right? It is not that much efficient. Clear? So if the market is efficient, it implies what? The market is being driven based on the finance principles, based on the finance fundamentals, because we calculate this value based on finance fundamentals, and that value also equal to the market value. How nice, right? If that situation is like that, that market is actually driven, right? You can come up with an argument, huh? That market is actually being driven based on finance fundamentals, right? Finance fundamentals in a very simple way. So we call such type of a market as efficient markets because the actual value and the value you calculated are same, right? Are same, but rarely found, rarely found. But if you consider about these situations, right? What you could say, efficient or inefficient? Since this is efficient, it must be inefficient, right? It must be inefficient. Why? Why? As an investor, you can manipulate. As an investor, you can manipulate because your price is different from the market price. Your price is different from the market price. So what you could do, depending on your position, buying position or selling position, you can make your decision because the prices are different, right? You can make profits. So here it's inefficient. Inefficient. Why? The prices are not same. You can execute your decision to make profits. But here the market is being driven by fundamentals. Accordingly, you cannot make such kind of profit. But usually, if you consider about the markets, markets are inefficient in nature. Right? Markets are inefficient in nature. So that is the meaning of that capital market efficiency part. Capital market efficiency part. Okay. You can ask any question. If you have any doubts. Online students, are you all okay with these things? Online students,
Yes, sir.
Right? Are you all okay? Fine. If you have any doubt, you can ask that. We are fine. Okay. Fine. Right. Okay, so now we are going to look at valuation of shares. Right? Valuation of shares. Listen now. Very simple, na? Valuation of shares. Now, is it okay if I erase this? Right? Don't look at the first statement. Don't look at the slide. Yeah? Don't look at the slide. Right. Right. Listen now. Now, you got to know that value can be calculated based on what? In the previous drawing, I have written it here. I think in black or blue ink. Value of an asset equals to what? Present value, right? Good luck. Value of an asset or value is equal to simply present value of its future or expected cash flows, right? Present value of expected. Present value means discounted value. Huh? Present value of its expected cash flows, right? Now we are going to do the valuation of shares. Very simple. If you consider about the share putta, right? If you consider about the share, what are your future cash flows? Good. Dividend. Dividends, it's correct. Yes, all nationals. Yes, what do you think? If you consider about shares, you have two cash flows. dividend and there is something called capital gain. For an example, you purchase the share, right? You purchase one share, right? You purchase one share, let's say, right? Purchase price is 10 rupees. Selling price is 15 rupees. What is the difference? 5. The difference is 5. What is the name that we are using for that difference? It's simply profit, but in terms of shares, we call it as capital gains. Capital gains. My simple question is, right? My simple question is, do you get this as a cash value? Do you get this as a cash value? Right? Do you get this as a cash value? Then what is the cash value that you get? Selling price. Understood? So in finance, we are considering present value of its expected cash flows plus selling price of the share. Clear? Understood? Right? Good, done. Good, good. So capital gain is not a cash flow, right? Capital gain is a profit. This is the you buy and you sell. You are getting 50. In mentality, you have that, yes, you are getting a 5 profit. Clear? So simply, if you consider about the share, these are your future cash flows. Understood? Simply, future cash flows are discounted by appropriate discount rate or cost of capital. I'll make it as R for the moment. Okay. Understood? Simply, to make it very simple, right? So dividend will be discounted based on appropriate discount rate, and the selling price will also be discounted based on the appropriate discount rate. Clear? So simply, these are the cash flows associated with shares, expected cash flows, and you have to discount it and you have to get the value. So this is simply what we know as dividend discount model, right? Dividend under dividend valuation, we have dividend discount and dividend growth model. So this is the dividend discount. What does it mean? You are discounting your dividend. You are discounting your dividend and you are getting the value. Understood? That's the simple meaning. Okay. But if you consider about the debenture, what are the cash flows associated with debentures? The debenture holder, what type of cash flows that you are going to get? Interest, then the maturity value or the invested value. Is it guaranteed? It's guaranteed. So as a debenture holder, you already know that your expected cash flows because it has been fixed. But when it comes to the shares, is it guaranteed? Nobody says that you are going to get the dividend. And what is the rate? When you are going to pay it, will it be changed or not? Nothing. And if you look at the selling price, it's your duty. Right? It's your duty. So accordingly, if we consider about the debentures, all the future cash flows are being known or could be predicted. But when it comes to the shares, it's very difficult to predict. It's very difficult to predict. Right? But we have models, but it's very difficult. That is why here it says at the very beginning, the valuation of ordinary or equity share is relatively more difficult. Look at that word, relatively implies that like debentures, right? Debentures is somewhat easy, but for the shares, it's difficult. Why? The difficulty arises because it is very difficult to know the values of these dividends. Clear? Is that understood? Right? So then it says the difficulty arises because of two factors. First, the rate of dividend in equity shares is not known. You don't know. Also, the payment of equity dividend is discretionary. What do you mean by discretionary? It entirely depends on the company willingness. Even though the company makes profit, they don't pay dividends, right? Depending on the company's willingness or the discretion. So the dividend of the equity share is expected to increase. So usually we believe that the dividend per share will be increased, but decrease could also be there. And sometimes company pay dividends, hold, hold. Such things could happen. So there is no any consistency of the patterns of the cash flows. Therefore, the estimation of the amount and the timing, right? The estimation of the amount and the timing of the cash flows expected by the shareholders are more uncertain, right? More uncertain. Then the earnings and the dividends on equity share are generally expected to grow, unlike the interest on bonds and the preference dividends. So those are the difficulties that will arise when you are going to value the shares, because there are two cash flows associated with shares, dividends and the selling price. It is very difficult to get the cash flows related with what? Dividends, because company has not guaranteed that you are getting a dividend. You don't know the timing of dividend. You don't know how much you get when. Accordingly, it's difficult. Even though you play any game for your selling price. Clear? Okay. Just read this. Right? Valuation of ordinary shares. Do you want to? Okay. Okay, I'll give you Right. So then when it's come to the dividend valuation model, basically we are using two aspects, that is dividend discount and the other one is dividend growth. Actually, we discussed the technical part and the practical part related with this. Accordingly, we'll have a discussion. Now here, you could see when it comes to the dividend discount model, simply what does it mean? You have your future dividend, you are going to discount it. We rename it like a model, we call it as dividend discount model. Basically. So here it says the value of a share today, right? Value of a share today depends on the cash inflows expected by the investor and the risk associated with those cash flows. That is what I have mentioned there. Right? So that is the fundamental principle that you want to know. Is how to generally calculate the value. Right? Cash inflows expected from the ordinary share consist of dividend plus capital gain. So here I have mentioned the capital gain because usually they are using that word, capital gain. Dividend with capital gain. Right? If you are a shareholder, you are expecting two returns, dividend and the capital. So to denote that, I have mentioned capital gain here, but you need to know that it's the selling price when it comes to valuation. Right? The value of the ordinary share is determined by capitalizing the future dividend stream at the opportunity cost of capital. Capitalizing means discounting. Right? You are discounting your future dividends from the cost of capital rate. Right? Discounting your future dividends from the cost of capital rate. Simply present value of its future dividends. Okay? Present value of its future dividends. Here it says in practice, there could be a difference between the present value and the market price, like we did earlier. Right? Based on this, investor can make a decision whether to buy the share or sell the share. You can calculate depending on the value and compare with the market value, you can make a decision whether to buy or whether to sell the share. Then the other one is dividend growth model. So we know that dividends do not remain same. It is growing. Right? It is growing. So we have another prediction in our model, just inserting a variable to calculate that. We'll see. Here it says dividends do not remain constant. Why? Company's earning increases accordingly. The company is in the position to pay a higher dividend. The company is in the position to pay a higher dividend. Earnings and dividends of most companies are low over time, at least because of their retention policies. Why? If you keep more retained earnings, you can invest and make more profits in the future and pay it to your shareholders. The specific purpose of the dividend growth model valuation is to estimate the fair value of the equity. Another name for present value is what? Fair value. Fair value. Once this fair value is calculated, what you could do, investor can compare the fair value with the current share or the unit price to determine whether the share is undervalued or overvalued. Same thing, right? The same thing which I have explained here is also explained here. Based on that, they can make a decision whether to find the share or sell the share. Finally, here it says, in a well-functioning capital market, there ought not to be any difference between the present value and the market value of the capital market is functioning. Yeah, you don't have any difference between the present value and the market price of the share. If the market is sufficiently proper, which means the market is being driven by finance fundamentals. Market is being driven by finance fundamentals. Right, okay. Fine. I'm clear. Actually, these are things that we have discussed, right? Example wise, as well as the discussion. So now we are going to start the valuation function as it's very easy. Using dividend valuation model, right? Using dividend valuation model. Now we have something called single period, right? Right. So dividend valuation model, right? Dividend valuation model. Now when it comes to the dividend valuation model, we have two types. According to your level, we have two types. That is single period valuation, and the other one is multi-period valuation. Right? Single period valuation, and the other one is multi-period valuation. Can you all hear me? Right? Single period valuation and multi-period valuation. So when it comes to the, don't look at there, don't look at there, please don't. Those are very simple things. Don't look at there. When it comes to the single period valuation, what happens is this what do you mean by single period valuation? In a very simple way, as an investor, you hold the share for a single period. Would be 1 day, would be 1 week, would be 1 month, would be 1 year. Right? Could be 1 year. Single period valuation. Right? Single period. Right? Single period valuation. So investor hold the share for 1 year, or 1 week, or 1 day. So you know that value of the share. Right? So you know that value of the share equals to the present value of its future cash flows. Present value of its future cash flows. So since you are holding, let's assume that you are holding a share for a 1 year period, and we'll assume that the company will also pay you the dividend, right? So the company will pay a dividend of 5 rupees. Then at the end, you are going to sell the share at a price of 10 rupees, right? At a price of 10 rupees. And the cost of capital rate would be 10%. This is a single period valuation. Accordingly, you can determine the value of the share. Accordingly, you can determine the value of the share. Clear? Very simple. Very simple, huh? Very simple. Now, we can convert this into like this, right? It's simply, we are considering future cash flows, huh? Accordingly, it must be next year dividend, right? It must be next year dividend plus your selling price, divide by cost of capital rate. And if we convert this into algebraical terms, right? Algebraical terms, this is how you get it. Okay. Now, in the previous example, I told you that you buy the share at a price of 10 rupees, you sell the share at a price of 15 rupees. What is the capital gain? 5. Capital gain is 5. Right? Capital gain is 5. Now, what happens here? Right? What happens here? Simply, what happens here? It is what actually happens. Right? You purchase the share by paying 10 rupees. The share has been increased by how much? 5%. Only for 1 year, right? Accordingly, we don't have, if we want this to make it, transparent, 1. The purchase price of the share is 10 rupees and it has been increased by 5%. Plus 1. You know why we have inserted 1 here, right? Because it must be multiplied from the same value. No? Answer must be how much? Answer must be 50, right? Answer must be 50. Am I correct? Right? You might have learned this formula in your grade 2. This is your future value. This is your present value. 1 plus r to the power n. Clear? This is your future value formula. Right? Then in here you could see that I have replaced this by putting like this. Next year dividend plus P0 into 1 plus growth rate divided by 1 plus r. Right? Yes. Thank you very much. Huh? You need to convert into percentage terms, right? Thank you very much. Right? Good. Right? So it's 50%, right? Simply selling price minus purchase price divided by purchase price. It's 50% and simply because this is your future value formula. Right? The next year dividend plus selling price, you need to discount. Same thing. This is another way that you can calculate your selling price. Okay, that is what I have written there. Right? For you to get the understanding, because anyone can do the valuation, but you need to know the fundamentals, right? Hidden things. Accordingly, if you hold the share for a 1 year period, value of the share equals to its expected future cash flows. You need to get your next year dividend plus the selling price discounting. You can get the present value without any issue. Right, so this slide is entirely explained in here. Right. Okay, online students, are you all okay? Online students, are you okay with these things?
Yes, sir.
Any difficulties?
So far, no.
Good. Right, okay, so we'll do a small question and we'll have a break. Right, we'll do a small question and we'll have a break. Right. Okay, right. So here you could see there's a particular question. Right, so we are going to do this entire 12. Right, so here it says, right, look at the question now. It says, Mr. Arun intends to buy a share and will hold it for 1 year. So once you read that part, what comes to your mind? Good. Single period valuation. That is how we segregate the question. Huh? Otherwise, then suppose he expects the share to pay a dividend of 5%, 5 rupees in next year. He expects the dividend to be paid rupees 5 rupees in next year. That is your expected dividend. And would sell the share at an expected price of 110 at the end of the year. If Arun's opportunity cost of capital or the required rate of return, simply the cost of capital, is 17%, how much should Arun pay for the share today? That is the first part. They have provided you with the dividend, selling price of the share, discount rate. Based on that, you can determine the present value of the share. Based on that, you can determine the present value of the share. That is the first part. Then, suppose the current market price of the share is 120. What Mr. Arun should do? That is the remaining part, right? That is the remaining part. So first you understood that it's a single period valuation. Then you know that price of the share today equals to next year dividend plus the selling price of the share divided by the cost of capital rate, right? Divided by the cost of capital rate. Usually when it comes to shares, we are taking cost of equity here. Your next year dividend, how much? Your next year dividend is 5 rupees. Selling price of the share? 110. Good. Discount rate? 17%. Price per share today equals to how much? Price of the share today equals to 100. 100. 100. A 90. Right? LKR how much? 98. So this is the answer for the first part. This is the value of the share. In the market price is 110, but it was 98 rupees for you, the present value of the share. Right? Then here you could say you have the present value and you have the market value. Your present value is 98 rupees. Market value is 110. Market value is higher than the present value, which means it is overvalued. What Mr. Arun should do? What? Sell. When the share is overvalued, you have to sell. Hope you remember that I told you, you need to determine the position of the investor right now. Here it says Mr. Arun intends to buy. Simply is planning to buy. Okay, that's the point. Huh? Planning to buy. Accordingly, the decision is what? Not to buy or hold. Not to buy or hold.
So here we need to compare with 110 or 120. Why you are not comparing with 120?
120.
Yeah, its current price is 120, right?
Your one is 120.
No, it's mentioned, suppose the current market price is 120.
Sorry, I haven't said it, right? Thank you very much. It's 120. Anyway, the answer is correct, no? Anyway, the answer is correct. Right. Thank you very much, Sudha, right? Thank you very much. I took this one mistakenly, selling price. Right, okay. Thank you. Fine. Okay. Very simple, no? Simply get the idea, right? Future values, you need to have the future values, then discounting. Right? Then discounting. Right. Do you need a break? Okay, so to the online students, are you okay with this? Are you okay with this? This calculation?
Yes, sir.
Right, okay. Okay, fine. Yes, you can have a break, 15 minutes, 15 minutes. Right? Okay. Right, yes, online students are you all available? Online students, are you all available? Right, okay,
Yes,
fine. Sorry, Buddha.
yes, available.
Okay, fine. Right, okay, so now simply you got to know how to value a share. If the investor holds the share for one single period or a single period, what is the other one? Very good. The other one is multi-period valuation, right? The other one is multi-period, right? Multi-period valuation, multi-period, multi-period valuation, which means the investor going to hold the share for more than one period, right? For more than one period. For an example, let's say investor purchases a share and he holds the share for 3 years, right? Investor purchases the share, he holds the share for 3 years. Year 1, year 2, year 3. Year 1, he is getting his next year dividend. Year 2, he is getting his year 2 dividend. Year 3, he is getting his year 3 dividend plus if he sells the selling price of the share, right? Selling price of the share. So then what we want to do, we want to discount it. Don't think about the letter that I'm using here, right? So it definitely is cost of capital. So it could be GORO, your name, right? Anyway, it's cost of capital, right? It's cost of capital, no cost of equity, right? Anyway, the discount rate. Right? So you are using a share for more than one period, right? Then you need to analyze the net cash inflows for 3 years and you need to discount it. Then you can get the present value of the share. You can get the present value of the share. That is what we know as multi-period valuation, right? Multi-period valuation. Right. Okay. So now we have another question. It's question number 2. Right. So we discount this finance to the, it's very easy subject, right? Finance is very easy subject. But the thing is, you need to read the question carefully, right? You need to read the question carefully and you need to have a familiar with the terminology of these concepts. Otherwise, sounds difficult. It sounds difficult. Right. Okay. So let's look at our question number 2. Right. Our question number 2. So here it says, Alliance Finance Company PLC, current year dividend will be 45. Where is this? Where is this? Right. Right. So Alliance Finance Company's current year dividend. This is question number 2, right? Question number 2. Current year dividend is how much? 45. Current year dividend is 45, which means dividend 0, right? Dividend 0 is 45 rupees. The company will expect the dividend to grow at a rate of 5% per annum for 5 years. Now, you could see that we are doing a multi-period valuation. The question implies that here it says the shareholder purchased the share and the dividend will be paid and the dividend will be increased. To get to know about the future dividends, we have been given the growth rate of the dividend. So we could say the growth rate of the dividend is 5% for next 5 years. For next 5 years. right, for next 5 years. The current market price of the share, the current market price of the share is 250 rupees. Current market price of the share is 250 rupees, and due to the higher volume involved in the finance sector, the company expects that the share to grow at a 5% per annum. Right now, you know that market prices are fluctuating. So here it says the market price will be increased, right? Growth rate of the market price is 5%. Growth rate of the market price is 5% per annum. Assuming the required rate of return is 10%, cost of capital 10%, what would be the price of the share if it were held for 5 years? What would be the price of the share if it held for 5 years? This is what we have to calculate, right? So simply you need to have a snapshot of this particular calculation, because when it comes to the lengthier question, definitely you may have 2 or 3 pages question in the examination. So better to highlight or make it as a summary, right? Make it as a summary like this, because it's very clear, right? It's very clear. Okay. Shall we try? Right? Okay. Now, what is the time period? For how many years? Very good. That is, these are the steps, easy steps. 5 years. 1, 2, 3, 4, 5 years. Current year dividend is how much? 45 rupees. Which means next year dividend will also be 45. No, the dividend will be increased at a rate of 5% per annum, right? So 45 current year dividend, we are going to add the growth rate like this, right? We are going to add the growth rate like this, compounded to 1 year. And we have to discount it. Cost of capital rate is also there. It's 10% for 1 year. Clear? This is how you calculate your next year dividend, right? Plus, second year also, you can either use your dividend 0 and add the growth rate and make it 0, or else you can calculate the year 1 dividend and keep it there, right? Yeah, we'll do it like this: 45, right? 1 plus 5% to the power 2 divided by 1 plus 10% to the power 2. Year 3, 45, 1 plus 5% to the power 3, 1 plus 10% to the power 3. Year 4 also 45, 1 plus 5% to the power 4, 1 plus 10%. Fine. And what happens at the end of the 5th year? What happens? Selling price is also there. Now, the current market price is equals to how much? Current market price equals to how much? Yeah, current market price is equals to 250. And they are saying that the market price will be increased at a rate of 5% per annum. So simply what you could do in the 5th year, this is the current market price. It will be increased by 5%. If you can directly get the year 5 rate there, discount 10% for 5 years. 10% for 5 years. Okay. Then here you can calculate the today price. Yes, what is the value? P0 equals to yes, what is the answer? How much? Yes, online students, what could be the answer? Online students,
394.
394.
Yeah.
Okay, fine. So we'll check. Yes. From group here, he's saying it's 394. Yes. What is it? Yes. Answer. 394. 394 is there. Yes, what is the answer? Yes, what would be the answer? 394. Okay, good. 394. 394. Okay, so since the majority says 394, yes. The price of the share today equals to 394. Right? So it's equal to 394, right? Okay, fine. Good. So this is what we known as simply multi-period valuation. Right? So you keep the share with you. Simply you're getting future cash flows discounted. Nothing. Right? Okay, fine. Right. Okay. Right. Okay, fine. Right, so now you simply know how to do a multi-period valuation and a single period valuation. And here you got to know that we have to use something called growth to calculate the dividends, your next year dividends. All right. Is that okay if I raise this? Right. Right, okay. So we are using growth. We are using something called growth rate to calculate the next year dividends. There are plenty of models available for you to calculate the growth. You can use industry weightages, you can use market for the macroeconomic fundamentals to calculate the growth rate. But for our simplicity, we are calculating the growth rate like this. Growth rate is equals to B multiplied by return on equity. Right? You know this formula, right? Growth equals to B multiplied by return on equity. B is your what? B is your retention ratio. Right? B is your retention ratio. ROE means return on equity. Right? Retention ratio means what? For an example, let's assume you earn, right? You earn 1 rupee. Right? You earn 1 rupee and you pay 70% as dividends, right? You pay 70% as dividends and the remaining 30% you keep it with you. So we call it as retained earnings or reserves, right? Accordingly, the amount that you pay, we commonly call it as your payout ratio, and the amount that you keep with you, we call it as retention ratio, right? Retention ratio, right? So payout ratio is simply equals to 1 minus how much you keep. Retention ratio equals to 1 minus how much you pay. Right? Simple, huh? You earn 1 rupee. Out of that 1 rupee, you are going to pay 70% as dividends. We call it as payout ratio. Then you have 30% with you. That is your retained earnings. And the ratio we call it as retention ratio. You are earning 1 rupee and paying 70%. So and keeping 30% with you, the answer is payout. How much you pay. You're earning 1 rupee and paying 70%. The answer is how much you keep. Retention ratio. Clear? Good. So we are using retention ratio and we are multiplying with our return on equity to calculate the growth rate. Simply we assume that our retained earnings are reinvested, which will generate a return of this much. That's the assumption, right? We have certain retained earnings. We are going to reinvest our retained earnings that will generate a return which is equal to ROE. Accordingly, our fund will be growth. That's the simple assumption of this particular growth formula, right? We call this as normal growth, rho constant, whatever. Then here you could see when it comes to normal growth, it says if a total equity finance firm retains a constant proportion of its annual returns and reinvest as its internal rate of return, which is return on equity, then it can be shown that the dividends will grow at a constant rate equal to the product of your retention ratio and the ROE. That is what it says, right? The same thing that I have illustrated in a very simple way. You have your retention ratio and you're going to reinvest it. We generate a return which is equal to your ROE. Right? Accordingly, there's a growth. Right? There's a growth. For an example, let's say you are going to put 100,000 in your savings account. interest rate, you assume 10%. At the end, the amount is 1,100. What is the growth? 100. Is that clear? Same thing apply here. Same thing apply here. Right. So this is simply how you calculate the growth, right? How you calculate the growth. And there is something, we have something called perpetual growth, right? Perpetual growth. Now, when you are doing the share valuation, right? When you are doing the share valuation, there is a limit for you to predict the growth, right? There's a limit for you to predict the dividends. Up to some sort of a year, you can predict the dividends. But after some time, it's very difficult. That's the normal practice. It's very difficult. Accordingly, we are using a particular model called perpetual growth. Perpetual growth. Simply, if the question is, or if the scenario is like this, you have been given a dividend for 6-year period, and they're asking you to calculate the value, right? You have been given the dividends for, let's say, you have been given the dividend for 1 year, year 0, and you are going to keep the share for 6 years, and the growth rate is also given. Simply, you can calculate your dividend up to 6 years. Is that fine? Right? But there are some situations where the growth of the dividend is not linked with the particular growth rate. In that case, you have to apply this perpetual model. If the dividend is linked with a number of years, it's constant growth. But if the dividend is not linked with the number of years, it's perpetual. Simply, we can say dividend will be grow at a rate of this much for 6 years. Right? Dividend is linked with the number of years. It's very easy. But if we say like this, dividend will be grown at a rate of 10% infinity. Do we have a number of years linked with? No, it's simply perpetual growth. Right? If the dividend is linked with number of years, it's constant or normal. But if the dividend is not linked with the number of years, right? We can say till the end of the life of the company, we are going to pay dividend. How to calculate the growth? It's difficult. So accordingly, we are using a particular model called perpetual growth to calculate the price of the share in such a circumstance. So we'll do a question. Here you could see it says the present value, right? The present value of a share, right? The present value of a share is equals to the dividend after year divided by the capitalization rate and the growth rate. This is the formula that we are using, right? I will explain how it happens and when to use, right? Just to know, get this understanding, this is the formula that we are using. If the dividend will be increased till perpetuity or till infinity. Now, when we are using this particular formula, Buddha, we are using several assumptions, right? Some assumptions are it's very practical and it's very open. Here you could see the first assumptions of the perpetual growth model. So here it says, now for an example, let's assume that let's understand these assumptions with calculations. Otherwise, it's no point. Let's say the price of the share equals to next year dividend, if it is a perpetual growth, divided by cost of equity minus growth rate. Right? This is your discount rate minus growth rate. Right? Let's assume. Please do the calculations for the following. Let's say your next year dividend is 5 rupees. Right? Next year dividend is 5 rupees. Calculate the price of the share if the cost of equity is 10% and the growth rate is 7%. Calculate the price of the share if the cost of equity is 10% and the growth rate is 10%. Again, calculate the price of the share if the cost of equity is 10% and the growth rate is 12%. Please calculate the price of the share for each these scenarios using this particular formula? Yes, using this formula, please calculate the price of the share. Here, price of the share equals to how much? Price of the share equals to, yes, online students. Huh? Yes, online students, how much? Simply you need to incorporate these two with this to this formula. Yes, what is the value? 5 divided by 10% minus 7%. 5 divided by 10% minus 10%. 5 divided by 10% minus 12%. For the first one, it's 166. 166. Okay. For the second one, for the second one, by just looking at the formula, don't tell the value. Just looking at the formula, don't tell the value. Second one, math error. Right. Third one, huh? Third one, third one, price equals to minus 250. Here is anything divided by 0, the answer is 0. Yes, online students, if any value divided by 0, the answer is huh? Infinity. Infinity. Wrong. It's plus or minus infinity. Right? It's plus or minus infinity. Consider about a particular, it's max, right? If it is 0, you can't tell if it is positive 0 or negative 0. Right? So simply you could see, is this clear? Now, which is more practical? Which is more practical out of these three? More practical share price out of these three? Huh? Which is the most practical share price? First one or the second one or the third one? First one. No? So this is more practical. Can you have a negative share price? Can we say 8 conspiring shares are being traded at a minus 250? We can't say. Accordingly, you could say when they're developing that formula, they said that, right? Listen this carefully. Yeah? When they're developing that formula, they mentioned that your cost of equity must be higher than the growth rate. Right here, you could see your cost of equity is higher than your growth rate. If that is only, you are getting a positive share price. Otherwise, not. Understood? That is the practical aspect of the first assumption. So they believe that cost of equity must be growth. Otherwise, you are getting some different. You cannot explain this. Right? John Kill's share price is infinity. Haley's share price is minus 200. It's not practical, right? So the first assumption is that simply we assume that cost of equity must be greater than the growth rate. Right? Cost of equity must be greater than the growth rate of the company. Is it clear, Buddha? Not that much clear, isn't it? What was the issue? Right. And the second assumption is, it's nothing to say. Dividend must be greater than 0. We know it. And the third one is the relationship between the cost of equity and the growth rate remain fixed till perpetuity. Right? Because we are using this particular formula to value the share. If the share is, let's say, if the growth rate is still infinity, right? We are using this particular formula for that. Accordingly, the relationship between these two must be perpetual, right? Must be perpetual because we are using this particular formula to value the share if it is a perpetual circumstance, right? So those are the three assumptions coming under this uh, particular perpetual growth aspect. What is the first assumption? Cost of equity must be greater than growth. I'm not going to ask these questions in the examination now. Prove the first assumptions. Never, right? But you need to go to the hidden part, right? Then the second assumption is dividend must be greater than 0. Third assumption is the relationship between these two is fixed and it remains till infinity, right? Remains till infinity, right? So that's the point that you need to consider. Okay. Okay, so please read these two slides. Online students, are you all okay with these things? Is this clear?
Yes, sir.
Okay, fine. Any doubts? Any doubts? No doubts?
Yes, sir. What is the purpose of calculating this?
What is the purpose of calculating this one?
No, the share value. The what kind of situation that we use? How the practicality of using this number?
Yes,
What are
yes.
situations that?
Yes, if it says that the growth rate of the share is not linked in the particular number of years, let's say this share, the dividend of the share will be increased at a rate of 10% till infinity. Is that clear? Till infinity. We are using this particular formula. Right? So the growth rate must be linked with a year. We are using that particular present value calculation. But if the growth rate is not linked with a particular number of years, we are using this perpetual buffer. Right? So once we do the next question, you can have some sort of an idea. Is that clear, Buddha?
Okay, sir. No,
Right, so
I
we'll do a
just want to
question.
know. I just want to know how the business use this number. What is the
Yes,
purpose of
yes.
using this then?
Yes, we'll see. We'll see. The question is there. We'll
Okay,
see.
sir.
Okay, good. Okay, please read. And we can have the question. Right, shall I erase this? If you have any doubt, you can ask any question. Right, okay, Uda. So we'll do a question. Right, listen, Uda. Okay, we'll do a question. Right. Okay, listen. So we'll see how we are going to use this particular formula. So here it says the current dividend of AIA insurance is 2 point, how many? 2.3, right? So the current dividend of this particular company, dividend 0, is equals to 2.3 rupees. 2.3 rupees. The required rate of return is 13%. That is cost of capital, or we could say cost of equity for the moment. Cost of capital. Let's say it's 5%. Right. So when you are valuing dividend shares, we have to use cost of equity, right? So here I have mentioned cost of capital doesn't matter, but of equity. Right. The current market price of the share is 28.5. Market price of the share is 28.5 rupees. Find the value of the share and determine whether the share is undervalued or not. Two things. You need to calculate the price of the share today, and you have determined whether it is undervalued or overvalued. These are the two things that you have to do. Okay, these are the two things that you have to do. Now, if you clearly look at this question, we have done single period valuation, we have done multi-period valuation. Right, so here it says the current year dividend of the AIA is 2.3, cost of equity is 13%, constant growth rate is 5%, the current market price of the share is 28.5. Find the value of the share and determine whether the share is undervalued or overvalued. Forget about the thing that I have written in red. Forget about. Is the dividend, is the growth rate is linked with number of years? Did it says the growth rate of the share will be increased at a rate of 5% for this year up to this year? Can you see it? You can't see, right? You can interpret this question in another way. We'll see it later. Accordingly, what is the formula that we have to use? That perpetual growth formula. So it is in here. It says we can assume that the dividend will be paid till infinity, right? Till infinity. Accordingly, price of the share equals to next year dividend. Our current year dividend is 2.3 rupees. We need to calculate the next year dividend by applying the growth rate. It's 5% divided by cost of capital, the cost of equity rate. Okay. So one can argue that can't be considered as a single period valuation. Forget about it. Right, so the price of the share is how much? How much? $2.3 multiplied by this one. Cost of sorry, I'm sorry, yeah. Cost of equity is 13%. Huh? Yeah. Yes, what is the answer? Yes, how much? 2 point. It's cost of equity minus growth rate, right? Next year dividend divide by the cost of equity is 13% minus your growth rate, that is 5%. Even I forgot the word. That is the formula. Next year dividend divide by cost of equity minus growth rate, right? Cost of equity minus growth rate. Then what is the answer? 30.1. The answer is, let's say it's 30. The answer is 30. The answer is 30. Right. So we have provided the answer for the first part. Second part is we have to determine whether it is overvalued or undervalued. We have determined whether it is overvalued or undervalued. Right? We have determined whether it is overvalued or undervalued. Right? So the present value that you have calculated is equals to 30. Market price of the share equals to 28.5. Your present value is higher than the market value, or the market value is lower than your present value. Undervalued to overvalued. It's undervalued. Undervalued. Clear? Is it okay for you all? Right. Okay. So we'll look into question number not 4. Okay, we'll the same thing is there. Right. Question number 4. Please try. Question number 4. Question number 4. Huh? Question number 4. Yes, question number 4. Yes. What is the answer? So you have determined the formula. Does the growth rate linked with number of years? That's the question that you have asked. Yes or no? No. Then what is the formula? Perpetual growth rate. Formula. Price today equals next year dividend. Here they have given you current year dividend has been given. Just pay. Then you need to add the growth rate. Here I have directly mentioned it as 8%. Cost of equity. Here it says market capitalizes. That is another word for cost of equity. Required rate of return, cost of equity, market capitalization rate, dividend capitalization rate. Those are some other synonyms for the cost of equity, right? So it's 13% minus 8%. So the price of the share equals to how much? How much? 180. Right. So the price of the share equals to 180. Right. Price of the share equals to 180. Okay. So question number 5 is for your homework. Right. Please make it down. Huh? Question number 5 is for your homework. If you can do that question number 5. Huh? Question number 5. Right. So let's look at question number 6. Now you know some sort of things. Based on that, we'll do the calculations. Right. Question number 6. Right. What does it say? Right. Question number 6. So here it says the previous dividends of commercial leasing and finance over the last 5 years have been as follows. Right. Clearly look at this. The previous dividends of the commercial leasing and finance over the last 5 years have been as follows. From 2020 to 2024 has been given. The company is entirely financed by 100,000 equity shares. The required rate of return is 24%. Calculate the growth rate and find the value of the equity share. Calculate the growth rate and find the value of the equity share. That's the way. Done. You go to my. Yes. Now, once you given the question, first you need to identify what you have to do. We have to calculate what? Growth rate. Then we have to calculate the value of the equity share. And we have to calculate the equity share. Now the first task is to calculate the growth rate. So how to calculate the growth rate? Right, do the something retention ratio multiplied by ROE, but you cannot apply that particular thing here, as I guess. Yes, online students, you all are with us, right? Online students. You all are with us, right?
Yes, sir.
Okay, thank you. Fine. Done. Yes, how it with the growth rate. Yes. Yes. Online students, any answers for that? Online students?
Yeah, 14%.
Listen. Yeah, please. Yes, Puna, what's the answer?
14%.
14%. Any decimals? Any decimals in your answer?
No, no, so I use that normal calculator. I didn't get the decimal actually.
Okay, fine. Okay, we'll see. Yeah. Right. It's very simple, right? But you need to know the rationale behind it. Right? Okay. Right, simple. Right, listen. Now you have learned that to calculate your next year dividend, right? To calculate your next year dividend, what you have to do? We are starting from the basic, basic. To calculate your next year dividend, you need to know your this year dividend. Then what you do? You add the growth rate like this. So simply your future value equals to present value 1 plus growth rate to the power n. Actually, this is the mathematical formula, right? Your future value formula. Now you got to know that, Puna, You are getting your next year dividend by compounding your current year dividend. Am I correct? You are getting your next year dividend by compounding your current year dividend. Are you all okay? In that case, you cannot just get the difference of those dividends and calculate the growth rate. Agreed? Okay. So you are getting your next year dividend by compounding your current year dividend. Accordingly, you cannot just get the difference of all those dividend figures and calculate the growth rate. Right? Simply the base is this particular formula. Base is this particular formula. And I think 2 or 3 have done the answer. It's actually very good. I'm very happy. Thank you very much. And so let's see what is the rationale behind it. Now, here it says the previous dividends of the company for the last 5 years have been given, starting from 2020 to 2024, which means now we are in which year? Now, 2022 for paid 20. Now the question says previous dividends, right? Previous dividends of the company have been paid. Previous dividends 20, 21, 22, 23, 24. Now my simple question is, in which year you are in? 98 marks, huh? 98 marks out of entire 100. Yes. You may either in the beginning of the 2025 or the end of the 2024. Clear? Please write those things, huh? You may be in the beginning of the 2025 or the end of the 2024. Accordingly, first thing that you need to do is here 2020, 21, 20, I'm writing this for purpose, 23 and 24. So you have the dividends, it's 150, then 192, 206, then 245, then 262.55. So these are the given dividend amounts, right? This is the formula. And these are the data set. Now you are in at the end of 2024 or the beginning of 2025, right? I am taking the rationale behind that formula, right? To calculate the growth rate, you have to go 5 years back. We don't know whether it is 5 years or not. Anyway, you have to go here. You have to go here. Now you are in here. Okay. From here onwards, you are looking at the future. Right? From here onwards, you are looking at the future. Accordingly, if you use this particular formula, what is your future value? Now you are in here. Earlier, yes, apparently we are in here. But to calculate the growth rate, we had to, right? We had to come to this particular year. Now, from here onwards, we are going to look forward. What is the future value? You would say. Future value? 262. Right? So your future value is 262,550. Now we go in here. What is the present value? 150,000. 150,000 plus 1 plus G, we don't know the growth rate, to the power N. N how much? N. We were here, we came here, 1, 2, 3, 4. 4 years. It's 4. Simple. Now this is how you formulate the formula. Right? Exactly, you need to know these understanding, huh? Definitely. Right? Then it's 262,550 divided by 150,000 plus 1 plus G to the power 4. Then 262.550 divided by 150 equals to how much? How much? 1.75. 1.75 equals, here you have 1 plus g. What you could do, here it's 4. Right, here it's 4. Click the shift, click the hex sign in your calculator, you can get this symbol. Online students, are you okay? Online students, are you all clear with this?
Yes, sir.
Okay. Then finally, what is the growth rate? Equals to 15%. The growth rate equals to 15%. This is not the answer. This is the one way or the one point of getting the answer. Right? Growth rate equals to 15%. Right? Okay, fine. So this is the growth rate. It's nearly 15.028083, something around. Then, listen, now you have calculated the growth rate, right? You have calculated the growth rate of the dividend. Then what we have to do, we have to calculate the price of the share, right? We have to calculate the price of the share. Now we were here. Now little by little we are coming to this point, right? Little by little we are coming to this point, right? So price of the share equals what? You have a growth rate. Does it link with the number of years for future? Does it link with the number of years for the future? Yes. Yes or no? Yes or no? No. Because the dividend growth rate is 15%. Sometimes after this, it could change. Right? It could change. Right? We are using the 15%, but it does not link with the number of years. Accordingly, what is the model? Perpetual growth model. You have to calculate your next year dividend. Is it how much? 262,550. 262,550. But here we are getting what? Dividend per share. Right? We are getting dividend per share. Accordingly, number of shares has been given. That is 100,000 equity shares. 100,000 equity shares. Once we sum up this, you are getting this year dividend, and you need to add the growth rate, right? You need to add the growth rate. Then cost of equity or cost of capital minus growth rate. The cost of capital is 24% and the growth rate of the dividend is 15%. The price of the share equals to equals to $34. Right. So the price of the share is equals to 34. Yes, online students, are you okay with this? Online students, are you okay?
Yeah, it's fine, sir.
Right. Fine. You can ask any question, isn't it? Any question? Any question? Right. Okay. So please note that question number 5 is what? Question number 5 is for your homework. Please attempt it by your own. Right? Please attempt it by your own. Okay. So now we have discussed something called supernormal growth. But if I discuss the theoretical part, I know what will happen. Then we'll discuss first. We'll discuss a question, right? Then we come up with the answer, and after that we'll go for the theory, right? It's bottom up, right? Practice question, then go to the theory, right? Bottom up. That's much better, I think, according to my practical experience of teaching finance, right? Right? Okay. Right. Listen, it's supernormal growth. What is supernormal growth? Yes. What is supernormal growth? Okay. Right. So now we'll do this question by doing. We'll understand the things little by little. Right. Question number 7. Right. Question number 7. Right. So here it says, La Holdings current dividend is 2 rupees. The company's current dividend is 2 rupees. It is expected to grow at a 15%. Now, this is the exact point you are using that model, perpetual growth model, right? This is the exact reason, and you can get the idea. It is expected that the growth rate of the dividend, right? The growth rate of the dividend is 15% for next 3 years. For next 3 years. This is the growth rate of the dividend. And thereafter, the dividend will be increased at a rate of how much? 8% till infinity, right? So the second growth rate is the dividend will be increased at a rate of 8% after year 3 till infinity, right? After year 3 till infinity. The required rate of return, right, is equals to 12%. You have to calculate the price of the share today, right? You have to calculate the price of the share today. So this is how we get the screenshot or the snapshot of the question, right? Is a dividend growth rate? We have 2 growth rates. One growth rate is linked with number of years. The other growth rate does not link with the number of years. Then you have the cost of equity, 12%, then the price of the share. you have to calculate. You have to calculate the price of the share. How you calculate the value of asset? Simply present value of its future cash flows. Accordingly, when it comes to the shares, also you are having dividends and the selling price. You need to estimate your future dividends and the selling price if it is available. Then you need to bring all these things into today's term, present value. If you look at this particular question, for how many years you need to consider in this question? For how many years? Apparently, it's for 3 years, right? Because it says the dividend will be increased at a rate of 15% for 3 years. So simply you're having year 1, right? Year 2, year 3. Year 1, year 2, year 3. Next. Year 1, year 2, year 3. Right. Okay, so how you calculate your next year dividend? It's simply your current year dividend is 2, and it says the dividend will be increased at a rate of 15% for next 3 years. So it's 1 plus 15% to the power 1. Here again, 1 plus 15% to year 3. Again, 1 plus 15% for year 3. Clear? Up to now, is it okay? This is how you calculate your future cash flows, expected cash flows, right? Dividends. Then you need to discount. Your discount rate is 12%. 1 plus 12% to the power 1. 1 plus 12% to the power 2. 1 plus 12% to the power 3. So we took this year dividend. We took this one. Online students, are you okay with this up to now?
Yes, sir.
Then what happens? Now, up to year 3, fine. It directly says the dividend will be increased at a rate of 15% up to 3 years. Up to 3 years. After that, it says the dividend will be increased at a rate of 8% till infinity. Does it link with the number of years? No, that's the first question and the answer that you have to ask from yourself. Does the growth rate of the dividend is linked with the number of years or not? It's not. Then we have to calculate something like this. We have to calculate, right? We have to calculate something called price of the share. Right? We have to calculate something called price of the share at the beginning of perpetual growth period. Right? We have to calculate something called. Now here, what is the ultimate objective? The ultimate objective is to calculate the present value or the price of the share. Here we have the series of dividends, discounting, and we can get the value. But after this point, we cannot use this formula. We have to use another formula, that is your perpetual growth formula. Why we are using it? Because the dividend is not linked with number of years. Then what we have to do, simply we can calculate the price of the share at the beginning of the constant growth period. I think this is the exact answer for the question that Gayan has asked, if I'm not mistaken. Right? You have to calculate the price of the share at the beginning of the constant growth period. Okay, so simply Buddha, the formula is, you know, your next year dividend divided by cost of equity minus growth rate. This is for the moment, let's assume that forget about either it could be cost of equity or cost of capital, right? This is the formula. Today price equals to next year dividend divided by cost of equity minus growth rate. This is the formula. But now we have to apply that formula to here. Right? We have to apply that formula to here. So simply, this is year 3, right? This is year 3. And we need the dividend of the next year. That is, simply we need year 4 dividend divided by cost of equity minus growth rate. Why? This is, now we are in year 3, right? Get the exact idea. Now we are in year 3. We need the year 4 dividend. Right? We need the year 4 dividend. How to get it? Now your growth rate has been changed after this point. Accordingly, you need to get the year 3 dividend. Why? You are going to do the adjustment for that. Clear? You are going to do the adjustment for the year 3 dividend. What is the year 3 dividend? How much is it? Your year 3 dividend. Multiplied by 1.15 to the power 3. How much is it? 3.0. 3.04. So once you sum up this, it's 3.04. Right? Why we have calculated this? Because the dividend rate is changed. We need to have a base to apply a new dividend rate. So new growth rate. So this is your year 3 dividend. Then you are applying your new growth rate. Perpetual growth rate is how much? It's 8%. 8%. That's only, right? That's only because you can't compound. You know the number of years. It goes till infinity. Year 3 dividend. You took the year 3 dividend. You apply the growth rate for that. Then this will become what? Year 4 dividend. Understood? This will become year 4 dividend. Sorry, yeah, year 4 dividend. Then, simple. Cost of equity is 12% minus growth rate is 8%. Clear? Understood? 1 point. When the price is 0, here this is your next year dividend. When the dividend is 4, your price must be, when you are having year 1 dividend here, this is the formula, right? Normal formula. When you are having year 1 dividend, you are getting the price for 0. Right? When you are having year 1 dividend here, you are getting the price for the 0 here. If you have dividend for, which year price you are going to get? Huh? Good. You are going to get the 3rd year price. Accordingly, once you sum up this, you are getting the 3rd year price. Right? You are getting the 3rd year price. Okay. So please sum up this, Pudha. How much is it? 82.08. So simply, once you sum up this, your year 3 share price is 82.08. Right? So you are getting the price for year 3 for the infinite stream of dividends. right? You are getting the price for year 3. Price for year 3, yeah. Price for year 3. For what? For the infinite stream of dividends. For the infinite stream of dividends. Then what we have to do? So you are getting the price for year 3. We need to convert into B0. We have to rediscount it, right? We have to rediscount it. To bring this to year 0, you have to discount this. 1 plus cost of 50 is this much. So how many years you need to bring it back? How many years? 3 years. You need to bring it to 3 years back. Then what is the answer? How much? I think online students, Zala, can you all see the bottom line of the whiteboard?
Yes, sir, we can see.
How much? 15.42. Alright, 58.42. Good. So simply you got the present value of the infinite stream of dividends. Then you have to calculate the present value of each of these cash flows. Yes, for year 1, what is the value? 2.05. 2.05 for year 2. 1.1. 2.1. 2.1 for year 3. 4.16. 2.16. Okay, good. So you have this value, this value, this value, and please add this value as well. Accordingly, you are getting the price of the share as how much? 75. 65. The price of the share is equals to 65. So this is what we know as what? Supernormal growth model. Why? Now you know that when the company could be in the different business cycles, introductory stage, development stage, growth stage, as well as the declining stage. So depending on their stages, the payment of the dividend could be changed, right? Depending on the stage that we are in, that they are in, their business life cycle, the amount of, listen this up, the amount of dividend that they are going to pay could be changed. But here we consider only one rate and we did the calculation. Now, when it's come to, let's say the declining part, now introductory stage, okay, development stage, okay, growth stage, then what happens? Declining stage. Now, when the company is in a declining stage, can they provide a higher dividend amount? If the company is in a declining stage, apparently no, but they're trying to maintain or they're trying to retain their existing customers. The company is trying to retain the existing customers. That is why here we assume that though the company has paid 15%, I mean, even though the growth rate of the company is 15% for the previous 3 years, after this stage, the company is trying to maintain a stable growth rate of dividends. Right? That is the rationale behind this. They can play any game in the introduction, development, and the growth stage. But when it comes to the declining stage, they cannot pay that much of a dividend. They need to retain their shareholders anyway. Accordingly, they will pay a stable growth rate. Right? Stable growth rate. So that's why you could see here the growth rate is high, but when it comes to here, the growth rate is low. Right? Growth rate is low. Simply, we call this as two-stage dividend model. Two-stage. This is your first stage, and after that, you have your second stage. Second stage. So see, this is simply supernormal growth model. Here, it's nothing. Simply you can discount your future dividends. But when it's come to this year, the dividend will be increased at the rate of, let's say, here it's 8% till infinity. At that time, please remember, you have to calculate price of the share at the beginning of the perpetual growth period. That is what we have done here. That is what we have done. So this is simply the supernormal growth model. Okay. Any doubts? Any doubts? So if you look at the lecture material, right? If you look at the lecture material, you can see, right? If you look at the lecture material, you can see that this is supernormal growth model. So here it says the dividends of a company may not grow, right? The dividends of the company may not grow at the same constant rate indefinitely. So it may face two-stage growth situation, two-stage. This is in between these two here. That is your first stage. After that, that is your second stage. In the first stage, dividends may grow at a supernormal growth rate like this, right? The rate would be changed, right? So in the first stage, the dividends may grow at a supernormal growth rate when the company is experiencing very high demand for its products and simply the company is making profits. They can pay. Afterwards, the demand for the company products may normalize, right? May normalize because the product is being known by each and every party. Then the demand is little by little getting lower. Therefore, the earnings and the dividends may grow at a normal growth rate after this period, right? So they are trying to maintain a stable growth rate. This is what supernormal growth means. So this is how you calculate the price of the share if it is a supernormal growth model. So simply you need to find the present value of the constantly growing dividend. That is this. Then calculate the present value of the dividend if it is paid for a perpetuity after the supernormal growth period. These are the two things. Simply, you have the dividends, get the present value. That is the first step. First stage. Secondly, you need to calculate the present value of the share when the dividends are increased at a perpetual growth rate. That is simply the supernormal growth model, and that is the end of today's lecture. So please check whether you are okay with the things that we have discussed. Yes, even online students, please check whether you are okay with these things. Right, because today we completed our webinar. We have completed our financial markets lecture. Then we started valuation. Listen, now. We started valuation. Then we had some sort of a sound introduction to the valuation part, right? Then we understood what is market efficiency, inefficiencies, volume, value, what type of decisions that you're going to make. Then our task is to value the share as well as value the dividend. We have started with valuing share. The first approach is dividend valuation model. You have dividend discount and dividend growth. Right? Dividend growth means you are applying the growth rate to the dividends. Dividend discounting means you are discounting the dividends. That's a very simple thing. So we completed a single period valuation. They are interest only for the share for one particular period. Then the multi-period valuation. Then supernormal growth. Remember, value equals the present value of the expected cash. Present value of the expected cash. If you look at this particular formula also, you can see. So you can ask any question, any doubt, any question, huh? Any doubt, any question, any doubt. Yes. Yes.